Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to this edition of the Retail Focus Podcast with Trent and Leighton Kling. Coming up on today's show, we'll talk three main stories. We're going to talk a little pet retail later on. We'll also discuss a luxury retailer released earnings last week, but we'll lead the show with Dollar General. Now, this is a smaller size show to whet your appetite. It's kind of making up for the show we missed last week. My apologies. I've been working a lot of overtime at the day job, so I haven't had a chance to sit down and record until today, but a smaller show today, and it'll set you up for a larger show coming over the weekend. In any case, go ahead and like us, follow us, rate us, however you find us, on Instagram and Twitter as well, at Retail Podcast. We lead our show, as we mentioned, with the dollar store space. Not really a dollar store, more of a old-fashioned variety store, if you want to put it that way, except an old-fashioned variety store on a huge scale, as in a much-anticipated earnings release for us, anyhow. Dollar General misses slightly on earnings, but posts a notable same-store sales increase. Now, this earnings report was for Dollar General's 2018 fourth quarter, meaning we also got full-year results. The call took place last Thursday morning. Now, the net result from the earnings call was a drop in share price over 6% at the time in trading Thursday, although I think were a little bit more impressed by the call than most analysts. Part of the bearishness was because earnings forecasts for the next year, for 2019, were lower than expectations. We'll get to that momentarily, but I think the main point here, Leighton, is for such a large, mature retailer as Dollar General, seeing same-store sales rise and outpace inflation by this much, very notable.
Dollar General is certainly a concept that we've been a fan of here in the recent past. I do want to backtrack just a little bit, quickly go over. Trent said 6% is how much they actually dropped in trading on Thursday. I was seeing decreases of around 10%. So a lot of pessimism in terms of those shareholders out there, investor sentiment out there. And I think a lot of this has to do with maybe the short-sightedness of management strategy with the company. But again, part of the bearishness is always going to be how they're going to be in terms of forward-looking earnings, and that certainly is coming into play here with this story. But the numbers for the fourth quarter, like Trent alluded to, very strong. And again, we are a fan of dollar stores in general, the concept of a dollar store. And Dollar General has had massive success over the last few months. Not only the last few months, the last few years, in fact, where they've increased margins, they've been able to maintain market share and grow market share in terms of certain categories like groceries, for instance, where they've installed coolers and freezers in some of their stores and have really looked at certain neighborhoods in which to do a different sort of business model. So they're competing with the Walmarts of the world and doing so in a successful way. We want to take that and look towards this latest quarter, and we see that fourth quarter revenue was up over 8% to $6.6 billion. It's a lot of money they're bringing in, but it's on the back of new store openings and same-store sales. So same-store sales were positive yet again for Dollar General. Revenue, by the way, for the entire year, since this was the fourth quarter earnings statement, up 9.2%. So even outpaced this latest quarter, which was pretty gangbusters if you ask us. But those same-store sales comps coming in at a very healthy 4% for the quarter, showing that Dollar General's procurement teams are executing well on their strategy to differentiate store to store, community to community. Same-store sales, by the way, for the entire year were up 3.2%. So that's a pretty healthy comp, about 50 or 60% above inflation if you want to compare it to the current inflationary metrics out there that we have to look at and scour through. Net income for the company came in at $483 million. Earnings per share for the fourth quarter hit $1.84 per share, more or less in line with what we were expecting and more or less the midpoint for the analysts out there. And gross profit, by the way, since we are talking about profit here with earnings per share, gross profit as a percentage of net sales was 31.2% in the fourth quarter. That was actually down. It was a sore spot here for this earnings call, down from around 32.1% this time last year. The reason being, Trent, more markdowns, more inventory, markdowns are one thing, but they have been bringing in lower margin consumables in order to draw traffic into all of their new and existing stores throughout the country. And by the way, acquire more grocery market share. So what I just said ties into this very thing in that they want to have a bigger grocery selection. Well, much of their customer base actually likes the lower price point items. Those lower price point items typically carry for grocery stores, especially ones that Dollar General is really trying to compete with here, lower margins. So those lower margins, yes, that is going to be a thing. That is part of their strategy. Thus, that should be part of the investor thesis going forward. So look at markdowns as a hugely negative thing for the company, but it's more than just markdowns here. It is truly about procurement strategy. And I think that's an important thing to take home from this, is that they know their customer base, they know what they want, and they know what is drawing in that traffic. Hence, total revenue in terms of the store comps, stores that have been open at least 52 weeks or greater, they have been successful at executing. And you can see that within those numbers. And I think it really rings true for those that have been really anti-Dollar General or anti-dollar store, saying that, you know what, Walmart is still going to dominate with this type of demographic. It turns out not so much. And with the strategy of increasing the number of stores in rural areas, I'm curious to see what they're able to come forth with the fourth quarter in next year. But as for now, we look at the expense side of the equation. Selling, general, and administrative expenses were 30 basis points lower for the quarter. You have to ask why. That's a pretty good thing for the company to see. Less repairs and store maintenance expense. And this could, honestly, we don't know. We don't know the details, the full details here, but per management statements, this could either be a good thing or a bad thing for the company, because if it's maybe a piece of luck that they have less store maintenance expense, less lights that are going out because they have new LED lights in some of their locations, or it's just willfully neglecting some areas of stores that they might divest in the future. They might close down entirely. We don't know exactly, but one thing is for sure, again, as a percentage of revenue, those types of expenses are down year over year. Last thing here to note, real quick before we move on, is that for the full year, they had an $11 million expense related to hurricane damage. So within that, they identified those stores. They identified those stores as opportunities to refurbish those stores, brighten them up a little bit, refresh the stores. So this was interesting in that they not only took a negative and turned it into a positive, they did so and addressed it in a hastened fashion. So they made sure to get those stores ready for the customers within a very short amount of time. You see a lot of other retailers doing that with hurricane damaged areas such as Home Depot and Lowe's.
So their annual cash flows from operations increased 18.9% to $2.1 billion. Of course, a function of a few different things. We mentioned the same store sales going up, selling and general administrative expenses going down, and also just the sheer number of stores increasing for Dollar General. As Leighton said, they continue to open up in rural areas, and we'll talk about that in our looking ahead story a little bit later on. And this cash flow can be used for their aggressive rural expansion even further. Also, some of that store remodeling. Leighton said, we don't know if they've been lucky or good as it pertains to stores needing renovations, but it can set aside some of this large amount of money coming from that cash flow to perhaps remodel or restore some stores, but also more share buyback is in plan. They increased their repurchase program authorization by $1.0 billion. They also increased their dividends slightly. Now, in terms of the comments, we look at Todd Vasos, the CEO at Dollar General. He mentioned, look, 2018 was a great success. They feel like they have a good foundation going forward, despite the fact that there was some bearishness on the numbers that they forecasted. And he mentioned it was driven, the same store sales were by consumable and non-consumable product sales, but categories that grew included consumables, and that's in part because they're just carrying more of them in the stores, but also seasonal and home categories. Seasonal, of course, so huge to Dollar General, especially their front of store presence, so it's good to see them doing well there. Now, this was all partially offset by declines in the apparel category, and when you add things to a store that doesn't change in square footage, something has to be squeezed out. And in the stores that we've seen with a larger amount of consumables and groceries, it is apparel getting squeezed out towards, usually when you walk into a Dollar General, the left side of the store, and that area for apparel is getting smaller and smaller. No longer the larger Dollar General stores starting to carry the selection of apparel that they once did, which in one hand kind of hurts some of those rural markets that depend on Dollar General for that apparel. But on the other hand, we think honestly this is a good idea because apparel is not really, nor should it be, a focal point for the discount retailer. They're finding their niche in other areas within the store and other key areas within the store. One other thing that benefited Dollar General, and this is something we don't really talk about a whole lot, is that the government did have an early release of SNAP monies, which helped cash flow and early revenues because more of that SNAP money going into consumers' hands, of course, that ending up flowing back to Dollar General, and something that you don't hear mentioned a lot for Kroger and Walmart, but something that does certainly impact their top line revenue. Most low-income assistance programs are tied to food, of course, and guess what? Not tied into apparel. So this is one of the reasons why Dollar General on the back end is kind of changing their goals within the store to include less from apparel, more from those consumables, and ultimately we'd like to see what percentage of food is purchased from state and federal assistance plans at Dollar General, but that number is only going to grow as Dollar General creates a name for themselves in consumables. And a smart idea, honestly, by Dollar General here. And this is something that you go back into the 90s, a lot of drugstores didn't really, and drugstore chains for that matter, didn't really carry a ton of groceries. Well, early in the 2000s, they started to change their approach a little bit, carry more consumables, carry more fresh and frozen goods, carry more milk and bread. And you're starting to see that from Dollar General too, where their turnover on those items a lot greater than what you would have from a retailer like Big Lots, who tried the same thing, but it just hasn't taken off like it has for Dollar General. Now, for that year ahead, they'll be working to advance their supply chain. More stores, of course, means more burden on their supply chain. So they'll be looking to bolster that a little bit. And here's a crucial part for Dollar General. They're looking to add in self-checkout lanes. Now, if you've been to a Dollar General in the last really 2-3 years, or really even in the last 5 years, you know they don't staff their stores very heavily. At any given time, you're likely to have 2 to 3 employees in the store, sometimes even fewer than that if you catch them on breaks or lunches. So those employees that are helping the people at the front of the store are also the same employees that are helping to stock. Now, an employee that's stocking has to stop stocking in order to check out someone at the front of the store. But if you install self-checkout lanes, that kind of erodes the need for the cashier to jump back and forth between stocking and the front of the store, and they can become more of a floor person than a front end person. And now self-checkout lanes will likely exist in some of their areas that are busier, but also some of their rural markets. You have to think that those are going to be installed simply because, again, they like to keep that staffing low within stores. Some Dollar General stores just don't seem to have the constant traffic of others. Therefore, you don't really need more than that 1 or 2 cashiers at a time in any case. But regardless of their exact plan outlay, they're open to spending around $50 million to improve in-store and out-of-store distribution processes. A large part of their distribution enhancements, this is where we talk about supply chain, will consist of food initiatives, and Dollar General ideally wants to be more hands-on with their own selection. Going back to that drugstore example, a lot of the bread in stores, a lot of the dairy in stores oftentimes is cultivated by third-party vendors, just like you see Little Debbie displays in a grocery store. Well, for Dollar General, what they want to do is try to curate their own selection, help to mitigate some margin issues that they've experienced with some of their newer food items by doing so. And Bastos said on the earnings call that he felt like there was some distribution voids across the country that have been exposed by their expansion program, and he wants to see those voids closed in. Bolstering that distribution set will effectively help them not only feed those newly expanded stores, but also put new stores in otherwise underserved areas so that if they can fill in those gaps, it in turn gives them more allowance to open new stores, and the cycle continues, and it's something that we see continuing far into the future.
Dollar General will also start its own click and collect service. A lot of people know this as maybe click and pull from the Sam's Club days, or all of the other services where you can shop online and pick up in store. For instance, the initiatives that we've been talking about at Target over the last couple of years and how they've expanded that service. Dollar General, for their part, is going to be doing the same thing. They're also going to launch, in cahoots with that, a private label baby product service and cosmetics brand. So I think this is going to be interesting because, again, focusing on margins here for their core customer. They know what their customers want. How can we get it cheaper? And how can we also profit a little bit more on that year over year? Dollar General, like we said, is using a lot of their income from continuing operations to fund new store development. They did that last year, they did that the year before, and they did that the year before that. They will be opening 975 stores in 2019. By year's end, they'll be approaching nearly 16,000 domestic locations. By the way, 1,000 stores are actually going to see a little bit of refreshing. So we talk about always having the mindset of reinvestment for the long term. They are doing just that. They are not pulling back. So everything that I said earlier about maybe they're just lucky that they have had lower maintenance costs with the existing store base, maybe that's true. Maybe that's true because they are focused on reinvestment activity, and they've shown time and time again that being able to have clean stores, bright stores, it's thrilling their customer base. All of this reinvestment comes at a cost, and that cost did not thrill shareholders. As we said at the very beginning of this story, Dollar General said it expects to earn around $6.30 to $6.50 per share in fiscal 2019. Average analyst estimates $6.65, so a little bit under that. They are not thrilled about the profit-making activity for the dollar store, but at the end of the day, this is a dollar concept that wants to stay around for the long term, and expansion, whether it's within the current store base or in new communities, is going to keep taking place. Shares of Dollar General, ticker DG, initially fell by over 10%, like I said last week on the news. Since, they've rebounded about 5%, regardless of the short term, regardless of that short term 5-10% drop, whatever you want to call it. We should say it was a pretty short-sighted reaction, at least from media outlets out there, because shares are near an all-time high. They closed this Thursday around $117 a share, which represents now a market cap near $31 billion. That dividend increase, by the way, they now have a dividend yield based on that share price of 1.1%. So not too bad for a retailer of the size of Dollar General, a price to earnings ratio of 19. And with that, we move on to our second story. And this is totally going to flip the script because we're going from discount dollar stores to a luxury retailer that Trent noted he was actually keeping a careful eye on the release of this retailer's quarterly earnings report. The privately held Neiman Marcus came out with results this week, and they were whelming, let's say. Not great, but not indicative of a cash and burn decline either. The retailer released earnings the same week as they introduced the new Manhattan area store. The new store opened on Friday, by the way, and comes on the heels of several closures over the past few years for the luxury chain. Several of the closures have come as the brand attempts to attenuate sales coming in from outlet channels versus traditional channels. And so with that, we look and see that this was as much of a middling corner as you can get, with positives and negative signs in equal measure. So a lot of different takes from those analysts out there after this was released. And for us, potentially the most negative sign was in digital sales, something management has attempted to focus on over the past 2 years. And Trent, the results for the fourth quarter ending January 26th overall were, let's just say, mediocre.
They were okay, and I feel like this is kind of a Rorschach test as far as an earnings call is concerned, especially since they're a private company, so they don't divulge quite as much information as those publicly traded companies have to. But again, it just depends on how you view Neiman Marcus through a larger lens, what you thought of this earnings call. There was some positivity, particularly out of the Dallas-Fort Worth area market where they're based, regarding this earnings call. I just don't see that same positivity. I think it's good that they didn't shed sales in the last quarter, but I think their digital sales need some help, and we'll get into that here in just a moment. Now, for that quarter, as Leighton mentioned, it ended January 26th. Overall sales increased just 0.7% to $1.39 billion, and while this wasn't bad per se, it didn't keep up with inflation either. Now, the company was quick to note that they were up against tough comps from the prior year's holiday quarter, where sales were up 6.7%. But we'd counter with the notion that that major increase last year was necessary just kind of to return the retailer to, I want to say break even, but not break even because they are still losing money, but kind of return them to holiday relevance after shedding sales the years prior. Although it was just a slight increase, it did mark Neiman Marcus's sixth straight quarter of sales growth. We talked on this very show back in 2016, kind of asking open-ended questions about what Neiman Marcus was doing because they were shedding sales, things were looking negative, and CEO Jeffrey von Raimdonk called it a period of stabilization. And I quote that, period of stabilization, although some could argue that they needed a period of growth right now, not more stabilization, because where they're at right now isn't exactly a stable spot. They're getting close to the edge of a cliff here, so being stabilized in that spot, not necessarily a good thing. As Leighton talked about, they are privately held, so no earnings per share numbers to go over. However, the company did show a loss of $29 million in the quarter. This compares unfavorably with a year ago. When you adjust to remove a tax benefit that they applied, the company lost around $15.3 million. So they lost more this year over last year when you take out that tax benefit they used last year. Part of this is due to increased expenditures. One assumes, of course, in the digital space, this is actually something they kind of alluded to there, but also in the development of their new New York area location. CapEx expenditures were up $5.4 million for the quarter over last year, and renovation or opening expense, of course, that New York store being in mind there, that was up $3.9 million over last year, where they basically didn't open any stores or didn't have a large store opening on the table. Another part of their increased costs and therefore their decreased profit, or increase in negative profit, if you want to put it that way, increase in a loss, I guess is how normal people would put it, that was due to interest expense, which increased to $81.4 million versus $76.5 million in last year's holiday quarter. And debt is a constant theme for Neiman Marcus. If you've been following the company, you no doubt noticed all of the releases that came out around late February, early March about their restructuring of debt. They were able to negotiate to kind of kick the can down the road by 3 years on its debt holdings, able to strike that deal in late February. And this is something that they were very, very excited about on their investor relations website because they do have a lot of debt. They have around $5 billion in debt. And one thing that we've noted on the show in the past, and we note again when it comes to Neiman Marcus, is that debt is getting more and more expensive to hold as lending rates increase, even for large-scale private lending like what a lot of these retailers engage in. The effects of CapEx and interest expense were partially offset by decreased rent expense, down by over $3.4 million, or in other words, around 10% versus a year ago. Rent will, of course, decrease when you have fewer locations. We talked about the closures, but even with the New York opening, Neiman Marcus is down to just 43 full-line stores now. They have just 24 last-call off-price stores. They had a significant number more just 3 or 4 years ago. And they still have the 2 Bergdorf Goodman stores in the New York area. Most recently, they closed 13 total last-call stores, with a few of those closed stores, of course, reflecting leases that are no longer on the books, thereby saving the company money as part of that $3.4 million.
As mentioned before, perhaps the most negative news from the earnings call is pedestrian digital sales growth. Digital sales were up, but just by 5.2%. And this is a number that we've seen in double digits for nearly every retailer out there reporting sales over the holiday. This despite what the company called a record-setting Cyber Monday. As we've discussed, the most effective retailers are seeing digital sales increases of well into 20%, 30%, 40% for the likes of Walmart and even Costco nowadays, who didn't even have a digital presence not that long ago, is reporting massive digital sales growth. Especially those retailers out there were a bit late to the full e-commerce investment game. You can see that is sort of going to be a learning curve for nearly every retailer out there. But Neiman Marcus has had a functioning website for some time, and they've been promising a lot more, and it just is not delivered in terms of revenue for the company. Neiman Marcus certainly fits into the category that was sort of a late adopter, but once they got going, they just haven't done a whole lot, and it's fairly disappointing to see that 5.2% number. You can make, and perhaps correctly make, the argument that Neiman Marcus is more of an experiential retailer, one of those retailers that you would go into an A-class mall and visit, sort of like a Saks Fifth Avenue or a modern Macy's, for instance, whose luxury feel is diminished on their e-commerce site. Be that as it may, it's still disappointing to see sales numbers here given their recent investments in digital. To wit, expenses in connection with strategic initiatives, including digital, rose to $9.1 million this quarter versus the $1.4 million in last year's quarter. So we're curious to see where exactly that investment is going and if that's going to result in a true impact from the top line perspective. Digital sales have been at the forefront of the company's focus for some time. Most recently, Van Raemdonk mentioned digital and data specifically in the release, announcing expanded roles for Carrie Tharp and Adam Arvos. Tharp was named as the new Executive Vice President and Chief Digital Officer in September of 2018. In addition to Tharp, the company created a role for Stephanie Sen, a Senior Vice President of Omnichannel Customer Experiences. So that's a lot to take in, and it's really tough to say, so I apologize to our listeners. And last June, Darcy Pennick was actually brought in as president of Bergdorf Goodman, and in the press release, and I quote, "This announcement comes as part of Neiman Marcus's group strategy to accelerate the company's digital transformation." So while it is still too early to judge the new leadership group's entire body of work in regards to digital retail, to be quite honest, the early returns suggest that either this transformation will take longer than expected or that the current initiatives just haven't yet gained traction with their current customer base. And that would make sense. A lot of these things do take time to iron out as they begin to evolve and learn as they go. All of these earnings took place against the backdrop of an ongoing lawsuit that was only this week tossed by a judge. The suit was brought by hedge fund Marble Ridge Capital LP.
And the basis for this suit was that Neiman Marcus moved its My Teresa unit away from creditors' reach into a distinct business unit. Now, this was theoretically done to protect My Teresa from creditors, at least as much was claimed by Marble Ridge. And by the way, My Teresa sales were not included in Neiman Marcus earnings. They are a German-focused e-commerce outfit. The lawsuit was actually dismissed for lack of subject matter jurisdiction, and I quote that by State Court Judge Tanya Parker. But based on Marble Ridge's reaction, this matter isn't done. In a statement sent to Bloomberg this week, Marble Ridge said that this ruling does not address the key issues of the transfer of assets by Neiman Marcus, and they argue that assets worth more than $1 billion were transferred for no consideration, and that actually the deal made Neiman Marcus insolvent because once that division was transferred away, assets at Neiman Marcus then outweighed liabilities. So they argued the insolvency of Neiman Marcus here. And again, a creditor sounds like they kind of want their money. They're tired of playing games with Neiman Marcus. And although this was dismissed, it's hard to picture this as the end of the debacle, but it's important to keep in mind as Neiman Marcus will no doubt have to restructure debt again in the future if they need additional runway beyond that 3 years. And what's more, is for a company that's fighting to remain profitable, is for a company that's struggling to stay afloat in terms of dipping into the red. These type of issues are going to create costs. Legal fees are very, very pricey. We've seen this with a number of other retailers embroiled in similar issues, and no different, no doubt, the case for Neiman Marcus. We finish up the news portion of our show by going back to pet retail this week, as the publication Pet Business notes that big box pet stores seem to be losing market share to independents. Now, listeners may recall back to my looking ahead from a few weeks ago where I kind of noted that Freshpet earnings results might be a sign that this very thing actually is happening. Freshpet saw substantially lower sales increases in big box pet stores, although the increases there were still decent for the company during their latest quarter, and that was versus grocery and general merchandise retailers and independents. So we said, hey, where are big box pet stores kind of fitting in this circumstance. And we've seen PetSmart in the news in particular a lot as they fight to not only remain relevant for those who own pets, but also fight to just maintain some semblance of profitability. We've had word that they've had issues with debt and that type of thing. And of course, Petco not that far off. And that's really who we're talking about when we talk about the big box pet retailers. We're mostly talking about PetSmart and Petco. These are the two businesses the article written by Mark Kalagian focuses on. And you can make an argument that Petland or Pet Supplies Plus and maybe PetSense should be included in this category. But realistically, you look at those companies, their locations have somewhat less national penetration than the others, and they have smaller footprints than those big two.
Yeah, and those big two are Petco and PetSmart, companies that we've talked about here on the podcast quite a bit. While there is little evidence to suggest that sales at Petco and PetSmart are shrinking per se, there is evidence that they are losing market share. We should be mindful that spending on pets overall is increasing. So as a basket of goods, let's say, in the United States, people are buying more for their pets, whether it's food, treats, or even toys. All of those expenditures are going up year over year, thus giving us a backdrop in which people are more willing to spend on pets. Losing market share now could mean loss of future repeat customers. So the economic theory here would be that once you lose a customer, it's extremely hard to get them back because human nature is pretty much all about forming habits. And if one person likes one of these niche pet retailers, chances are they're going to go back and be a repeat customer there instead of a big box store. Part of the increase in spending is driven by discretionary income overall, of course, but the number of household pets in the United States is expected to continue to increase as well. So not only do people have more money to spend on pets, but they also have more pets to spend that money on. And according to the American Pet Product Association's National Pet Owners Survey, the average dog or cat owner drops from around $200 to $300 annually just on food for their pet. So an increase in pets equals an increase in potential spend for food, even without any increase in spending on the per pet basis. And we see that in any case, this is the first year in around 20 years that the combined sales of PetSmart and Petco in the pet retail space make up less than 50% of the market share. Broken up, it's around 27.3% for PetSmart, 19.9% for Petco. This is still substantial, but 6 years ago, if we go back just a little bit, according to Pet Business, the two stores captured around 64% of the combined market share. So that is a pretty drastic drop in overall market share in the United States. And this is a relatively quick shed of market share if you look at any other business model out there, especially for a business, like I've been saying, that is growing. So usually the winner stays at the top because they see the trends coming. But it's actually been the opposite. Niche retailers or even general merchandise retailers have really been attracted to having those pet supplies, the pet food in their stores and creating more shelf space, more sales floor space to house those goods. And the potential for growth in smaller store concepts has been borne out in the larger 5-year numbers in regards to pet retail. According to IBIS, the store sales, the pet store sales, that is, retail sales not including grocery sales, general merchandise retailers, and so forth, have grown by 2.9% annually since 2013. And total revenue from these pet stores alone topped $19 billion in 2018. Much of this has to do with the growth in store numbers, 2.2% growth in locations per year during the same time frame. So Trent, you have to ask the question, this is reflected somewhat in PetSmart's growth from around 1,400 locations in 2014 to 1,656 locations in 2019. But still, though, there's a lot to dig in from these numbers and a lot of explaining to do if you're one of those two big retailers.
Yeah, and I think the numbers look interesting when you look at the primary competitors of PetSmart and Petco, because PetSmart, we see that they're growing in terms of locations. Again, adding around 256 locations over the last 5 years alone. And again, when we're talking about revenue, when we're talking about store growth, we're talking specifically about pet retailers. So we're not talking about, the Walmarts, Kroger's, Dollar Generals of the world that may also carry pet supplies and pet food. When we're talking about store sales growing by 2.9% annually, just talking about those pet retailers, And this is where those competitors come in. According to Pet Business's annual top 25 retailers list that they just released, PetSmart and Petco 6 years ago were responsible for 70% of their list's store count growth. So this is to say, when you look at that list 6 years ago and what that looked like 6 years ago, the store growth, 70% of those top 25 stores, the store growth was coming from PetSmart and Petco. However, over the last 6 years, the two were only responsible for 34% of the growth in that list. So you went from being responsible for 70% of the growth of the list down to 34. And there was significant growth overall too. It's not just that we were seeing small unit growth in that span. 2,379 units over that span were added for those top 25 pet retailers. So in the last 6 years, we've seen the number of units grow incredibly in the pet store space, and much of that coming from independents. So sales have increased 2.9% yearly, but one of the interesting things to note is the number of employees has grown even more for these pet stores yearly, 3.5% per year, in fact. So the number of employees outpacing the increase in sales. The pet store retail sector alone employed over 132,000 people in 2018. But the big question here, why the increase? Have pet store retailers become less efficient? Could this be one of the issues with PetSmart, since staff and staff costs have increased at a higher rate than sales? Well, yes and no is the answer. Certainly, it could be an issue with efficiency, but a lot of the increase actually comes from the increased investments in pet services, which is where some of the independents are starting to catch up with those big box retailers. You look at PetSmart and Petco, very common to see grooming and veterinary centers there. Banfield Pet Hospital's partnership with PetSmart has paid off in years past, maybe not so much now because the independent pet stores are starting to catch up. And when you offer things like grooming and daycare as services for pets, well, guess what? You have to staff those services. And revenue from pet services, again, according to IBIS, has also been increasing. And it's a key differentiator between online outfits like Chewy.com, Wayfair, and Amazon. You can't get your pet groomed at one of those companies. So if you look at drawing people in, if you look at spurring on traffic, a lot of these independent retailers are putting their eggs in the pet services basket because they know people are going to spend money on other things while the pet is in the store getting groomed. So ultimately, we wanted to kind of close out the story by looking at some of the catalysts behind the loss of market share, Leighton.
One, of course, is that the continued growth from main competitors still exists. Tractor Supply Company has nearly doubled down on PetSense, their pet concept store, especially in small to mid-sized markets. We've talked about Pet Supplies Plus and their success through their franchising model. The writer of the article that spurred this story in the first place suggests that smaller retailers are doing a better job of taking advantage of their regional nature, catering to individual markets or to a particular niche. However, the most notable thing he mentioned in the article is what he calls a, and I quote, new class of independent retailers led by star distribution networks. The reason this is intriguing to us is because basically it's a return to an older style independent distribution network that was actually popular in the 1950s, like one that was championed by Ace, True Value, IGA, and many others. And it's an interesting business model and one that is a little bit daunting if you're a legacy retailer like Petco or PetSmart.
Yeah, and part of the reason we bring this up and part of the reason I wanted to bring this into the story is just the fact that, you know, it's kind of remarkable because for years you had, you know, the True Values of the world, the Aces of the world, the IGAs of the world, and you've started to see, not necessarily for Ace and True Value because they're still doing quite well, but in terms of those overall concepts, those cooperative concepts, we're using common distribution networks, that type of thing, you just haven't seen as much of it lately. And even, you know, with Ace and True Value, that used to be the way you got your hardware and the way you got your lumber. And now you're seeing, obviously, Home Depot and Lowe's take a lot of market share in those particular markets. But here you have these distributors, one being independent pet partners, but there are others that are out there that are linking up with independently, locally owned pet stores to kind of bolster distribution to these pet stores. And it's made a major difference. So you have these smaller chains or these one-off chains that are getting this massive distribution capability from company like Independent Pet Partners. And I think you're seeing that kind of bolster what we're talking about, because independents can expand more quickly. You're not focusing as much on distribution. And you can also create kind of a mini chain, including Kreiser's, one of those stores that does use those distribution mechanisms. They've got stores in Southern California, Colorado, Illinois, Texas, all over the place. And that wouldn't be possible in the past without a distribution mechanism. So I think these distribution mechanisms are really allowing the independents to take up battle with the likes of PetSmart and Petco. You combine that with poor PR on the part of PetSmart and Petco. Every now and again, you see stories about pets dying when they're in PetSmart or Petco's care. You see negative stories in that regard. You also see negative stories about PetSmart just trying to stay functional, trying to get out from underneath debt. And all of that adds up to this situation where you're seeing online companies, sure, take a lot of market share. And I think a lot is talked about there. But I think the key here is the independent retailers really expanding. You see Pet Supplies Plus starting up that franchising model. And I think you're just seeing so much competition in this space, not only from those independent retailers, but also, like we've talked about, from the likes of grocery stores and general merchandise retailers. Honestly, even though spending on pets continues to increase and based on data, again, is likely to continue increasing as people continue to add pets into their household, it's a really tough road forward for PetSmart and Petco despite such a growing industry.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
We reached the final segment of the Retail Focus podcast, where Leighton and I take a look ahead at one story we're keeping an eye on for the next week, month, or year. We start with Leighton.
My looking ahead has to do with two things, one being Shopko and one being the real estate that's going to be affected by Shopko closing all of its doors. It was announced earlier this week. A lot of our listeners may have heard that they're going to be closing all of their over 300 stores that were left. During the bankruptcy proceedings, they did not find a buyer, so therefore those stores are going to be closed, and actually liquidation sales are going to be starting at the end of this week and early next week for the remainder of their store base. And this is going to affect a lot of communities, namely the smaller communities. You have those stores that are going to be left vacant for quite some time. Think back to the Alco bankruptcy of a few years ago. Those stores, several of them, still are vacant to this day, have yet to find a home tenant. I think there's a very large redistribution maybe or redevelopment opportunity of what's going to go in these spaces. If you think about residential properties, maybe there's already one municipality that's talking about leveling the building altogether to create a 3 or 4 story apartment building. So it looks as though some communities are ready and willing to make the proper advancement in order to not have the vacant space and have sort of a bad look on those immediate neighborhoods. But for those other larger buildings that Shopko has, for instance, maybe a gym could go in some of those. But my point here being is over 385 buildings are going to be vacant with just a couple months to spare. In order to really see what's out there in the market, I'm curious to see what this does for investors and what this does for those local communities. But just one thing unrelated to what I just said that has to do with Shopko. It's been actually found out here through these bankruptcy proceedings over the last couple of weeks that they've issued hundreds of millions of dollars in dividends here lately to management. So that's an interesting take, because a lot of people were saying, well, management has totally misguided the company and made it unsustainable for the future. But maybe, in fact, they were profitable, but just hoarding too much of that cash and not reinvesting properly in the Shopko brand. So I think that's an interesting take. And if that is indeed the case, that is a very, very sad story. If you think about those employees, the buildings, the Shopko brand, the legacy that it's had over the years, the ups and downs for that retailer, one of our favorite retailers when it expanded throughout the Midwest years ago in its larger store format, that is truly, truly a sad thing if that's true. But overall, I am going to be looking at the future opportunity for these retail centers that they're going to leave abandoned.
Well, keeping with that theme, my looking ahead story also has to do with Shopko, but not the real estate. It has to do with the market share. There was an article earlier on Motley Fool, and that took place earlier this week, that said Kohl's and JCPenney actually stood to benefit the most from Shopko closing their doors. And one thing to keep in mind in regards to Shopko, and I get the sentiment behind that, but one thing to keep in mind when you're talking about Shopko is the lion's share of their locations were in these smaller, underserved markets. And so you're seeing a lot of those locations closing. A lot of the big locations, those mega locations, the 90 or 100,000 square foot locations, they had already closed down by this point. So a lot of the locations that are left are these smaller locations in rural towns. Many of them actually reopened in areas that the Alco stores closed down in. Others were purchased, recall, from the Pamida buyout that took place by Shopko. Pamida, a long ago brand there in a lot of rural areas. So you have all of these smaller 20 to 30,000 square foot stores, and the reality of it is the market share left behind by them, who is in the best spot to take advantage of that? Well, the obvious answer there is Dollar General and Family Dollar, because most of these stores don't exist in markets that are large enough to have a Walmart. Usually they exist in smaller markets of 2,000 to 6,000 people. And now, even if you liked shopping at a Shopko in one of those markets, you have no other place to go. And I actually liken it back to my experience in one Shopko hometown market in Ulysses, Kansas. I was in rural Ulysses, Kansas to cover a sporting event back in the fall, and there was a Shopko hometown right across the street from a Dollar General, right across the street from a Family Dollar. And you could say the town of Ulysses, it was about 6,000 people. You could say very fairly that it was over-retailed because they also had a farm and home retailer, a grocery store retailer, and so forth. But Shopko, their grocery section wasn't robust in the hometown stores, but what was robust was a little bit of the apparel section, but mostly general merchandise retail. And this is an area where Dollar General and Family Dollar can pick up the slack. So I think in all of this, we're kind of forgetting about the businesses that could benefit from this going forward. Dollar General certainly one of them, but then you look at the Family Dollar brand that has been so maligned by analysts and investors alike that Dollar Tree owns. And a lot of those stores actually stand to benefit if that dollar spend from Shopko ends up going their way. So right now, I think it's crucial in those rural markets for Dollar General and Family Dollar to amp up any type of spend that they have in terms of promotions, and for those companies to be focused on that. I think it's too early for Dollar Tree to back out of the Family Dollar concept because of this reason, and because I think there is a lot there to it when you're talking about rural markets. Something that Walmart tried out a few years ago, that didn't work with their express concepts, but still people are spending money at those stores. Just because those stores aren't profitable doesn't mean people aren't spending money. They're just not spending enough money. So Family Dollar and Dollar Tree, we know those stores are more or less profitable, even though Family Dollar has proven to be a bit of a money pit for Dollar Tree. And I'm looking forward to see how this impacts them going over the next year or two. Now, a lot of these markets with Shopkos, you might say, well, that makes up a very small number of markets that Family Dollars or Dollar Trees are in. But still, when you look at the macro picture, I think it opens up markets for one or the other to expand in if you don't have a particular presence in that town. So one good example would be, I was in a rural market in Colorado recently. They had a Shopko hometown and a Dollar General, but no Family Dollar. Could this open it up for a Family Dollar to move in, maybe get some cheap real estate like what Leighton was talking about, to split off the store and go forward from there? So anyway, that'll do it for this edition of the Retail Focus podcast. We'll be recording again this weekend. We'll come at you with a second edition this weekend as well. Make sure and follow us on Twitter and Instagram at Retail Podcast. We'll be back with you soon.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.